Hey everybody, welcome to this free edition of our Trader User Group for the trading weekend in June 28th, 2024. I'm President Brent. Thanks for tuning in. Well, this marks the halfway point in 2024. Markets are up very strong. Uh, July is traditionally a bullish month, but we can expect a little bit of a pullback here over the next sometime in the summer months, July, August, September timeframe. We've gone about 400 days since the markets have had the S&P has had a 2% pullback in any given day. So that's getting a bit stretched. So let's take a look at how we fared this past week, and then we'll go from there. Um, if we look at the U.S. markets, Dow and S&P flat for all practical purposes. So's Nasdaq and Russell are basically flat week. Couple slightly in the red, couple slightly in the green. Year to date, everybody's strong. Russell moved back into the green again this week, just barely though, just above zero. Um, so kind of a light news week that we had this week. Banks were prominently featured by the Feds. They basically did a stress test on them, 31 large U.S. banks, and they remained above their minimum capital levels. So that allows them to increase some dividends, return capital to their shareholders, via dividends, stock buybacks, things like that. So that'll be helpful for the financial sector when that hit this week. In fact, we did see that move up a little bit. Also, the big number coming out this week was Friday's PCE. That's the personal consumption expenditures. It showed that prices, taking out food and energy, we'll look at the core, it rose 10 basis points in April. So that is the Fed's preferred measure of inflation. So it showed a little bit of deceleration from April, which was revised up 30 basis points. So all in all, that was fairly mild and tame. We did get some consumer sentiment data that showed consumers feel inflation is coming down a little bit, so that helped the markets a little bit. Although after a run up, we did finish in the red for the day, for the trading day. Okay. And we looked at long-term treasury yields. Over the course of the week, they did move up, kind of heightening the expectations that, we're going to have a rate's going to stay higher for longer. Now, if we look at the PE ratio, you can see on here, the trailing is a whopping little over 24. Forward is 22.27, fairly high. Okay. I think it's a little bit higher than it should be. Dividend yield coming in similar to last week, about 1.33 for the S&P. Treasury, as I said, finished out the week just slightly under 4.4%, coming in at 4.39. Okay. The VIX, a very docile week. It fell from the prior week's close of 13.20 to 12.44. So the VIX has been very docile for quite some time. I am expecting a little bit of a dip sometime over the next 60 days or so. We should see the markets pull back a little bit and consolidate these hefty price gains as we've moved through the halfway point for the year. You can see the best sector for the week was energy, worst was utilities, and then the best for the year is communication services, real estate bringing up the rear at 2.49%. Okay. And of course, if we go over and take a look at the European markets, you can see Europe mostly was in the red for the week. DAX was the only lone holdout, coming in at 39 basis points. We did see the inflation rate come in a little bit lower across many of the countries in Europe, and France and Spain came down a little bit. Although in Germany, jobless rates rose up a little bit to 6%. All right. So a little bit of a mixed bag. And Germany's the big engine that drives all of the European members of the ECB. So the jobless rate in Germany is the highest it's been in 3 years. Okay. Also, we did see in Germany business confidence weaken just a little bit. Okay. So that kind of put a little bit of a monkey wrench in most of there, although the DAX did come in at 39 basis points to the upside. Year to date, everybody is in the green with the exception of the CAC 40. It fell back. They got the big French elections this weekend. So we'll see how that shapes itself out. All right. And then, of course, if we look at the Asian markets, the Nikkei, Japan, very strong week, strong year to date numbers. In fact, it's leading the way just slightly ahead of the NASDAQ here in the US, 18.21%. there's a lot of heightened expectations that the Japanese authorities are going to step in to take advantage of and reduce the sharp decline in the yen against the dollar. But Japan is still putting stimulus out there, putting a lot of money in the economy, unlike the U.S. So there's a big divergence between the U.S. dollar yen, and that's what's created this big issue here. Meanwhile, in Japan, we did get their core CPI data for June, showed inflation up at 2.1%, which is more than consensus. Now, remember, in Japan, they want higher inflation. The prior month is 1.9. They'd like to see it consistently come in over 2%. So they're trying to prime the pump over there. And then, of course, if you look at the Chinese markets, they're a very light economic calendar this past week for China. Their industrial profits came in, and some of their larger companies were up 70 basis points in May. But that was down from April's 40 basis point gain. So there's still a lot of issues in China in the real estate market. So we'll see. That's put a big drag on all of the Chinese market. Hang Seng also in the red for the week, but it is up just barely year to date. What I'm going to do is shift you over and show you a couple of charts here, just to kind of give a quick and dirty roundup for the weekly roundup this weekend. I'm going to start with the S&P 500 E-mini futures contracts. And as you're going to be able to see here shortly when it comes on your screen, Friday it was down a little over 13 points, but you could see how we're hugging the all-time intraday highs at 58 or 55.88. Okay, now I do have some potential pullback points, and I do believe we will get a little bit of a dip in action. Now, remember, July is traditionally a slightly bullish month statistically if you go back over the past 20 years and take a look at the SPX on the monthly basis. But I think you can see here we've just kind of run sideways. The MACD does not show any divergence, so that does suggest that any dip down here is going to be a buying opportunity. And you can see the 50 EMA is sitting at 53.50 roughly. I've got a firm support sitting at around 5,400. So again, I would not be surprised to see a 120, 130 point pullback over the next couple of weeks as it leads up to the next Fed meeting in July, right? And keep in mind that the markets are still diverging from the Feds. The markets believe there's going to be 2 rate cuts this year. The Feds are saying 1. So we'll see how that shapes itself out. But we do have a Fed meeting in July, and then we do not have one in August. And then we follow up with a meeting in September to round out the Q3 numbers, okay? And you can see my pullback points here estimated at 54.15 all the way down to roughly 52.89. It's the midpoint of an anticipated pullback that I'm looking at here, okay? If we look at the Dow, you can see the Dow, again, just like S&P, it's just a sine wave. We haven't gone anywhere, really going all the way back to March of this year. We haven't really gone anywhere. We've been in the red just slightly back in early May. We got close to making new highs back in late May. That was the big, not very much, but we traveled a little bit. And now we're kind of back and we pull back just a little bit. So the Dow is hanging in there, but really not much in the way of Dow movement. Okay. And then, of course, if we look at NASDAQ, and let me just find it on the screen here. It was down on Friday, but just slightly up for the week, about 77 basis points. You can see the NASDAQ is kind of hugging its all-time intraday highs here like this. So I do believe we'll see a little bit of a pullback here in these. And this also leads up. Remember, we've got Q2 earnings coming out in a couple of weeks. And here in the U.S. markets, for those of you that watch our sessions or in our sessions that are European or based or Asian based, it's going to be a big holiday week for the U.S. with July the 4th, our Independence Day. So July the 4th is a full day off. A lot of people are not aware, but July the 3rd, there's going to be a half trading day. The markets close at 1 p.m. Eastern Standard Time. So the markets are going to be closing, but I imagine after the morning gets by on the 3rd, traders are going to be heading out the door, and then there'll be a very quiet leading up to the stop trading time at 1 p.m. Eastern time on the 3rd, and then we open back up on the morning of the 5th. Okay, so a nice little holiday week for U.S. markets. But you can see here that we go into the earnings, Q2 earnings, and then it leads up to the Fed. So the markets, this is the time, I think, for markets to consolidate, unless we get some news that surprises people. Okay. And then finally, if we look at the Russell, you can see it's dancing around the red-green line for the year. This line here separates being in the red or being in the green for the year. You can see right here, it was in the red for quite some time, and now we just moved back up into the green again, just barely. The Russell's up 77 basis points year to date. So just barely in the green, but it's hanging in there, okay? We haven't had a divergence like this in a long time between the Russell and NASDAQ. NASDAQ is up 18% for the year, and the Russell, for all practical purposes, is flat, okay? It's been a long time since we have a divergence like that, and that just shows the lack of breadth in this market, okay? None at all, actually. And if we come down and we look at the VIX, let me just find the VIX on here. You can see here it closed out the week at 1244. So we've been in the green all week. And if we look at the front month volatility skew right here, it's in the green. All right. So it's a normal backwardation skew. Contango rather. I'm sorry. It's a contango situation right now. So we're in the green. And then if we look at the backed month skew, you're going to see it's in the green also. So it's just a normalized contango situation. So the markets, even though we moved down on Friday, the VIX barely moved. In fact, the VIX was flat to slightly down. So that just shows the markets, it's a yawner, right? We're coming into the summer season when markets liquidity starts to get a little bit less than you normally see in the winter and fall and early summer. So that's kind of what I'm seeing there in volatility. And of course, if we look at the bond market, a hard day down on Friday. Look at that. And that means yields go up. Remember, when bonds go down, yields go up. So we're going to see bonds probably drift sideways to slightly down, leading into the Feds. And then the Feds, let's see if they reiterate just a 1 rate point cut for the year. The markets, again, are still forecasting 2. So that always is a precursor for moving the markets around. So we could get a little bit more of a pullback if the Feds come out a little bit more hawkish than expected. Okay. And then, of course, if we look at currencies, the dollar is still very strong. You'll see the dollar hovering near its highs for the year, right? I mean, we had this little bit of a rounded bottom shape here, which suggests a little bit of a cup and handle kind of pattern, and then move up before we start moving back down again. Okay. And again, this is the dollar index. So the dollar index moves based on how other currencies move. If we look at the euro, Euro is down. The 50 EMA is below the 50, and price is below the 50. So this is a bear market chart for the euro, right? We're not at, but we're near the lows for the year for the euro, which isn't that much, but the euro is down, and I do believe the euro is going to start to recover here and start to move up. But now's not the time to play the euro to the upside. The yen, however, is a completely different story. It's like 34, 35-year lows. You could see the yen on Friday, down very low. So I do like this to the upside. Members, we'll talk about this in our session Sunday evening. So that's a little bit about what I'm seeing in currency markets. If we look at gold, I have said gold is going to be pulling back over the next couple of months. You can see here it's holding on. It closed below and then above the 50 EMA. It was the same pattern here. It closed below the 50 EMA and then it moved back up again. So same pattern. So I'm expecting a little bit of weakness here in the gold market in the summer months, and then it'll pick up back into the fall again. So people that got long right here, it didn't quite hit my target. My original target was all the way up here around close to 2,500. We actually got up intraday right at 24.54. So that was very close, but not quite. But now the 50 EMA is holding. Should that break, which I believe it will, we're going to come down and test this gap up here around 22.50. We'll see if that holds. It may not, over the summer months. And then we just come back down to around the 2200 area. And at that point, I think gold will be a much more interesting buy. And of course, if we look at silver, it follows gold just a little bit. You can see silver, the last high in silver is back in May 20. It's holding the 50 EMA as well. You can see it held over here. 2 days closing below and then immediately came back up again. There is no divergence in the MACD. That does suggest you want to be a buyer here, but the Elliott wave count has shifted to an Elliott wave 3 down. That suggests you want to be a seller of rallies here. So we're going to watch this very close. I do believe both gold and silver will go lower over the summer months, and then we'll have a fall rally for both of them. And that would be the time if you want to play it to the long side. And then, of course, if we look at energy, energy is just kind of, again, for members in our group, we have a great way to play this. You can see the 50 EMA railroad tracking the 200, and then it moved up a little bit. So that's firm support underneath, right around $79 a barrel. It's at 81 right now. You could set 75 as the trade, the primary focal point for the trades we like to do on oil. But I do believe that oil, any dip is probably going to be bought in the oil market at this point in time. All right. You have a lot of geopolitical risk. You've got a lot of Iran, possible Israel, Hezbollah issues. So that's keeping a little bit of a fear premium built into a barrel of oil at this point in time. Okay. And then finally, if we look at nat gas, this was the time to go long nat gas. Now it's pulling back here. It is there is a little bit of a divergence here, so that does suggest it could probably come down just a little bit more and then consolidate, move up. I'd like to see it move up, take out these highs, give us a bearish divergence again, and that'd be worth a shorting opportunity. Right now, I don't see a trade in nat gas. The trade in nat gas is back over here in March, April timeframe. All right, everybody, that's a really quick and dirty on the markets this past week. Nice holiday weekend coming up, July the 4th, Independence Day. Hope everybody has a fun time. Members, I'll see you this Sunday evening for our weekly market watch. If you're not a member, I highly encourage you to come in. Just a couple of our trades, especially the way we trade some of the commodities, you can make some nice money in. All right, everybody, have a great weekend. Take care, folks. Ciao.